Welcome to chapter 16, second to last chapter in Accounting 112. We're going to be doing the cash flow statement in this chapter. Now, I will admit, when I was in your shoes, when the cash flow statement was ever discussed, I got shaky and sweaty palmed and I was nervous. And that's because my professors never taught us how to do this. So they basically threw us to the wind and hoped something would stick. I'm not going to do that for you. I'm going to make sure we get you where you need to be for this, and we're going to discuss this, and hopefully this will work for our advantage here today. All right. Here are your learning objectives. I will not be going over the Appendix 16A or B. Illustrate use of a spreadsheet to prepare a statement of cash flows. No, I'm not going to illustrate how to create it in a spreadsheet, and I will not be doing the direct method. I will only be teaching the indirect method. The direct method is using the income statement, and it's relatively straightforward. And like everybody does the indirect method. So anyway. So what is the purpose of the statement of cash flows? It is basically to explain that one line item on the balance sheet that says cash. That's it. It wants to show how a company receives its cash, how it spends its cash, where it comes from, and why it's going. All that information is going to be explained in the statement of cash flows. It's important because cash is basically what makes a company run. If a company doesn't have the cash or the assets needed to be used for the company, it's going to have a shortfall, not be able to pay its debts. It's going to have a lot of problems. It's going to go under. It's got to have the ability to pay its debts. Cash flow, basically the criteria is things that are cash, readily available to be converted into cash, and so sufficiently close to the market, the maturity that a market change isn't going to be impacted by it. Our focus is just cash. Here are your three areas of a cash flow statement: operating activities, investing activities, and financing activities. I used to be in the military. I was in the Army, and I went to Iraq twice for the operations over there. And the first operation that we got when we went over there, I went in there in 08, was Operation Iraqi Freedom, OIF. So that helped me remember this for the CPA exam. OIF, Operating Iraqi Freedom, Operation Iraqi Freedom, Operating, Investing, Financing. That's the order in which we're going to do this statement of cash flows. Operating activities deals primarily with the inflows and outflows of cash for a operation standpoint. This is a critical one because if a company is not able to produce enough cash from its operating activities to pay for its operating activities, then there's a problem there. The company, if it is not able to sustain its operations by what it's doing, is not going to be sustained. So any negative cash flow out of the operating activities needs to be scrutinized as to the why. Now, there are reasons, and they're okay reasons if they do, but I need to find out why because it's a big red flag. Investing activities, the way I look at this is the company is investing in itself. It's either buying assets to be able to receive investments, interest and other things, or plan assets, or to sell investments and things that it has as assets. That's what we're looking for. Is it's investing in itself in some way. Investing activities can be good or bad depending on the circumstances, and you'd have to evaluate it based on a case-by-case situation. Financing activities is the way the company finances big projects and things like that. So it can get this through issuing common stock, issuing long-term debts, basically chapters 13 through 14, yeah. 12, 13, and 14, excuse me. It's used money to pay dividends to shareholders, treasury stock to purchase treasury stock or to reissue. Owners can withdrawals in the form of either owner withdrawals or dividends, however that case may be. And it is also used to pay off short and long-term debt, the actual amounts, the principal on it. Links between classification of cash flows and the balance sheet. Okay. Current assets and current liabilities represent the operating cash flows. Long-term assets and long-term liabilities represents the investing and financing activities respectively. That's a good way to look at this to kind of help you assess as to where things are plugged into. So this is a good slide. I definitely recommend printing that off or keeping that there. Non-cash investing and financing activities need to be indicated somewhere on the financial statement, specifically possibly some kind of as a note or somewhere else, but non-cash investing and financing activities need to be annotated on the statement of cash flows. So we're going to prepare a statement of cash flows. This is what it's going to look like. You're going to have your cash flows from operating activities and your investing and financing activities, and then you're going to have a reconciliation at the bottom showing showing the increase or decrease in cash, the beginning balance, and then the ending balance as they mathematically compute. Therefore, you should have the same balances showing on the balance sheet. And I said earlier, it says a note. Oh, it says say a note. Separate schedule or note disclosure of any non-cash investing financing transactions is required. I said a note. You can have a schedule if needs be. So preparing the statement of cash flows, you can pause this and look at this. I'm just going to do it to kind of show you how to do it. First, we want to analyze the cash account. We need to know the beginning balance and we need to know the ending balance. Once we have that, we've analyzed it and we're ready to move on. Oh, well, that's, yeah, you do the cash flow account basically by that. Okay, so of course, yeah, you can do that. So we're going to be doing it based on non-cash accounts though. So we can find out how to do it. There's two ways to do it, but we're going to do the indirect method. And we need the comparative balance sheet, current income statement, any additional information. The indirect method is how we're going to do this. Like I said, what we want is the direct method and the indirect method are going to be two different things. The direct method is just going to be basically cash paid for certain things, as you see indicated up there. But we're going to do the indirect method, which is going to take all of the current assets and current liabilities and everything else and calculate that way, and that's how we're going to do it. I'm going to show you how to do that. Here's the information you need. You have your income statement, you have your balance sheet, and then you have some additional information that will help you get there. First off, we're going to start off with the indirect method. We're going to do items from the statement, the income statement that do not affect cash. First of all, we're going to include depreciation expense because what we're doing is we're starting off with our net income. And then we're going to adjust net income so that all we have left is just stuff regarding cash. So what we got to do is we either got to add or subtract anything that we used that was a non-cash transaction to get to net income. First thing, and is most common, is depreciation expense. Since we subtracted that to get to net income, we have to add it back in. If we have any losses on any sale or anything else, that's a non-cash event that got us to net income. So any losses we're going to add back in as well. Any gains for the same reason losses, except we're going to subtract it because we added that to net income. And then any changes in the current assets and current liabilities will depend on what the change is and whether it was a current asset or a current liability if we're going to adjust it. So as you can see, any increase in a current asset is going to be a decrease to net income. Any decrease in an asset, current asset, will be an increase to net income. And any decrease in a liability, current liability, will be a decrease to net income, and an increase to any current liability will be an increase to net income. I'll have a slide soon to show you how to do that. So here are the adjustments again, depreciation, any gains and losses. Then this is something you've got to print off. You've got to have this. Okay, this is your daggum golden ticket, holy grail or whatever of how to do these things. If you have this here, you should never flub the operating activities section. Current assets is a subtraction from net income when it's an increase. You add it to net income when it's a decrease. The opposite for liabilities. If the current liabilities increase, you're adding it to net income. If it decreases, you're subtracting it from net income. All right. So there's your second part there. We already showed you. So here's your summary of adjustments for indirect method for the operating activities. Okay, then the rest is the same, whether it's investing or financing activities, and it's just logical. If you spent money to purchase something, it's going to be an outflow. If you bought something, if you sold something, it's going to be an inflow of cash. And then you report the effects. So let's look at this. The analysis reveals a $40,000 increase from plant assets and a $12,000 increase in accumulated depreciation. Okay, we probably bought something there, right? Probably bought some plant. We may have even sold some. So let's look at this. Item B, Genesis purchased plant asset of $60,000 by issuing a $60,000 in note payable to the seller. Well, that's not a cash event, so we're not going to deal with it. We will put that in the notes, though. All right, or we will do something in the back because that is something big. With item C, reports Genesis sold plant assets costing $20,000 for $2,000 cash, resulting in a $6,000 loss. Okay, so the loss we dealt with on the operating activity, so we're not dealing with that. But we do have accumulated depreciation and plant assets, which we had a $2,000 cash increase from that sale. All right, so we're going to also figure out that. Plus, we also had that $24,000 accumulated depreciation expense. So we see there that there was a $12,000 increase to accumulated depreciation, which is what it said before. And so we've now accounted for our accumulated depreciation, and we're good for that. All right. So what was, let's see what our, oh wait, no. There we go. All right, so we see our T account issue here. So we have $2,000 cash received from the sale of plant assets, and we're good. And we're going to put this non-cash investing and financing activity in the notes of that $60,000. All right, now financing activities. Again, we're going to do the same exact thing. We saw long-term note payable increase by $26,000. Likely, we issued a note. All right, let's see what happened here. Step 2, oh, blah, okay. Notes with carrying value of $34,000 are retired for $18,000 cash, resulting in a $16,000 gain. All right, so our note payable decreases. We pay out $18,000 cash and receive the gain. We already dealt with the gain. We reduced it, so we had cash paid to retire the notes was $18,000. Any financing through common stock or otherwise, we are going to have a cash inflow. So we have cash for the common stock of $15,000. So we're going to see a $15,000 increase. Retained earnings had a reduction probably from, we got to factor in net income and then cash dividend of $14,000. Be aware that your dividends can be a non-cash event too, so be careful about that. So then we have it all there. We reconcile. We see the cash paid for dividends and retire the notes, but increasing in the issuance from stock. All right, here's the summary using T accounts. Please just be aware of this. This is a great way to keep things as well as understanding it. It shows you where everything is up there in the cash account. All right, so total asset ratio. This one's pretty straightforward, I think. Here, let me get to the calculation. Operating cash flows divided by average total assets is your cash flow on your total assets. Basically, of all of your assets, how much cash flow are you deriving in your operations from those assets? The ratio to look at and help you. I'm not going to do a spreadsheet to prepare a statement of cash flow because it should still be pretty straightforward. And then the next one is compute cash flows from operating activities using direct method. I'm not going to do that. So I'm going to do a snippet on how to do a cash flow statement. I recommend you reviewing that as well. This is the end of chapter 16. Your word for this chapter is Kelly. 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 Kelly as in Kelly Kapowski from Saved by the Bell. You guys have a good one. We'll see you guys in the next chapter or in the other videos. Green. Hi, Brian with Truly Nolan. How are you? Pretty all right, except for the scorpions and stuff.